Stop scrolling for just 60 seconds. I need you to perform a small act of rebellion. Find the nearest financial news headline. Maybe it's on your phone, your computer, or that television in the background. Read it. Absorb it. Now I want you to hold that headline next to 3 pieces of information it deliberately omits. Does it mention the WC-135R Constant Phoenix, an aircraft so specialized its only job is to sniff the atmosphere for nuclear particles currently circling the Persian Gulf? Does it discuss the strategic repositioning of B-52 Stratofortresses to a runway so close to the Iranian border that the heat distortion from their engines blurs the horizon? Does it even whisper about the vaults beneath the streets of New York, where a precious white metal is being evacuated at a rate of 20 million ounces every single 30-day cycle? No. Instead, it offers you a comforting narrative. Diplomats exchanged pleasantries in Geneva for 3 hours, describing the atmosphere as constructive. It tells you that a deal, that magical panacea for all geopolitical ills, is still theoretically possible. I want you to take that headline, that carefully crafted piece of perceptual management, and crumple it up in your mind. Throw it away, because the analysts feeding you those words are looking at a different reality than the one laid out in front of me. They are not staring at a military logistics map time-stamped just days ago. They are not cross-referencing the position of 2 aircraft carrier strike groups, over 100 fixed-wing fighter jets, a flotilla of Tomahawk-capable submarines, and that specialized nuclear detection aircraft, all forming a tightening noose around the Persian Gulf. They are ignoring the schism in the silver market, where the industrial miners, the men and women who blast ore from the earth, are settling contracts at a real price of $69, a figure wildly disconnected from the digital quotation of $80 on your screen. And they certainly aren't doing the simple arithmetic, dividing the 88 million ounces of registered silver left in the comex vaults by the 20 million ounces exiting them each month. If they did that math, they wouldn't be writing about diplomatic progress. They'd be writing an obituary for the paper pricing system. You are now watching the convergence of 3 distinct high-impact crises. They are not arriving in a staggered, orderly fashion, giving you time to adjust your portfolio. They are colliding within a single compressed 72-hour window, a military trigger, a legal detonator, a physical inventory cliff. Individually, each could move gold and silver. Together, they form the most potent catalyst cluster this market has witnessed in a decade. Welcome to the reality beneath the headlines. We begin our examination on this Friday, the 20th of February 2026. The digital ticker displays gold at $5,277.70 bid, a robust gain of $32.50 on the session, pushing its head above the $5,000 threshold for the first time since its record peak of $5,589 just 3 weeks prior. Silver mirrors this ascent, trading at 80.37, up 195, a healthy 2.49% move, with a session high kissing 81.33. To the casual observer, these are merely strong numbers, but to the trained eye, they are the market's equivalent of a dog barking before an earthquake, a sign that it senses the tremors long before the humans do. It is a market that is not requesting permission to move. It is acting on information that hasn't yet been formatted for public consumption. Let me be unequivocally clear. In this environment, waiting is not a passive state. Waiting is an active, deliberate decision with consequences. Before you make that decision, you must understand the 3 theaters of operation that are simultaneously active. First, the military theater, centered on the strategic waterways surrounding the Strait of Hormuz. Second, the legal theater, contained within the marbled halls of the United States Supreme Court. Third, the physical theater, hidden inside the registered vaults of the comex in New York. These are not isolated news stories with separate implications for your wealth. They are the 3 legs of a single, converging event. The direction of this convergence over the next 48 to 96 hours will determine whether gold and silver experience a violent repricing to the upside, or whether we see a brief, sharp corrective window, a final sale before the doors are locked and the next leg higher begins. I have spent years dissecting supply chains, analyzing vault reports, scrutinizing miner earnings, and tracking central bank flows. In all that time, I have never had to open an analysis by discussing military deployment maps and nuclear detection aircraft alongside precious metals fundamentals. That singular fact should communicate the gravity of the moment. To understand this moment, you must hold 3 distinct numbers in your mind simultaneously. Not 1, not 2, but 3. The first number is 80. This is the price the paper market in New York assigns to 1 ounce of silver this morning. It's the clean, digestible number on your screen, the one quoted on every financial ticker, the number that forms the basis of most market participants' reality. The second number is 69. This is the reality at the mine gate. This is what the primary producers, the companies that drill, blast, refine, and physically deliver the metal, are actually receiving in real settlement prices after navigating the labyrinthine mechanics of the paper market's delivery system. The screen says 80, the miner's bank account says 69. Ponder that chasm. That is not a simple deduction for freight or storage. That is a declaration that two separate realities are operating in parallel, the reality of the screen and the reality of the physical industry. They cannot remain divorced indefinitely. The third number is 99. This is the price that industrial buyers in the East, specifically on the Shanghai market, are willing to transact at for physical silver right now. Stand back and look at the landscape these three numbers describe. New York's paper market values the asset at 80. The primary producers of the asset realize 69. Eastern industrial consumers are paying 99. Three distinct prices for an identical underlying asset. In a healthy, functioning, and liquid market, these numbers converge. Arbitrage mechanisms force them together, allowing for efficient price discovery. But in a market under structural duress, where physical inventory is being depleted faster than it can be replenished, where the entities that set the paper price have a well-documented history of suppressing it, and where industrial demand is driven by forces immune to paper market sentiment, these numbers do not converge, they diverge. And currently, they are not just diverging, they are moving in opposite directions like tectonic plates grinding beneath a calm ocean surface. Underpinning all three of these prices is the stark reality of the COMEX vault. It sits with 88 million ounces of registered silver, bleeding at a rate of 20 million ounces per month. In a stable environment, this represents a runway of just over 4 months, a manageable, if concerning, figure. But this is not a stable environment, and the events of the next 72 hours could act as a multiplier on that drain rate, transforming a manageable situation into an acute crisis. The compression spring is fully wound. The only question remaining is what triggers its release and how violent the subsequent expansion will be. Imagine for a moment a specific scenario. You are the head of procurement for a major defense contractor. Your production lines are dependent on a steady inflow of silver. This isn't a speculative investment, it's a structural input. It goes into guidance systems, satellite components, and the electronics for precision hardware. You cannot substitute it with aluminum. You cannot delay production hoping for a better price. Silver is a line item in your bill of materials, and it must arrive on schedule. This morning, your procurement officer places a report on your desk containing 3 alarming data points. Data point 1, your primary source for physical delivery, the COMEX registered vault network, currently holds 88 million ounces. The current drain rate is 20 million ounces per month. Simple math gives you just over 4 months before a delivery crisis becomes structural and systemic. Data point 2, the United States military has positioned 2 aircraft carrier strike groups in the waters surrounding the nation that sits atop 20% of the world's oil flow. Over 160 military cargo flights have surged into the region since mid-January. B-52 strategic bombers, aircraft designed to deliver nuclear payloads, are now stationed at Al Udeid Air Base in Qatar, the forward headquarters of U.S. Central Command. A senior advisor to the former president has publicly placed the probability of military action at 90%. The USS Gerald R. Ford is en route to the eastern Mediterranean, and U.S. officials have explicitly stated its arrival is a key factor in the operational timeline. Data point 3. In a show of coordinated defiance, China has dispatched 16 military cargo planes to Iran in the past month. Simultaneously, Russia and China are conducting live joint naval exercises with Iran inside the Strait of Hormuz. Defense analysts confirm these exercises are specifically designed to inject complexity and uncertainty into any U.S. operational planning in those crowded waters. Your procurement officer sets the report down. The question hangs in the air, simple and terrifying. If the Strait of Hormuz closes for even 2 weeks, disrupting global shipping lanes and the refined silver scheduled to move from processors in Switzerland and Australia is delayed by an unknown number of weeks, on top of a COMEX vault already running on a 4-month fuse, what is your course of action? The answer requires no advanced degree in logistics. You do not wait for a lower price. You do not hold out for a better entry point. You pick up the phone and call every supplier with accessible inventory. You agree to whatever premium they demand. You lock up your supply now before the procurement officer at the competitor across town runs the same calculation and buys the metal you were counting on. This is the mechanism. The physical shortage creates a baseline urgency. The geopolitical trigger eliminates the luxury of patience. When industrial buyers, defense contractors, solar panel manufacturers, electronics assemblers, EV battery producers all run the same calculation in the same short window, the $80 paper price in New York becomes a historical artifact, a relic from a time before the real clearing price was established by whoever arrived at the refiner's door with cash first. But why is this specific convergence happening now? Why are the military buildup and the market stress arriving in the same window? Because the deeper force driving both is the accelerating erosion of the dollar system's authority to unilaterally set prices and enforce outcomes. Look at what the comex vault drain actually represents. It is not simply inventory leaving a building. It is the physical world refusing to validate the paper world's pricing claims. When miners accept $69 in real settlement for metal quoted at $80, they are not making an error in arithmetic. They are signaling that the settlement mechanics of the paper market routinely produce outcomes that diverge from the advertised price. That is what miner premium data tells you about the structural health of the paper pricing mechanism. It's terminally ill. Now, view the Iran situation through the same analytical lens. The previous administration imposed sweeping tariffs using the International Emergency Economic Powers Act, i.e. EPA, a statute designed for sanctions during national security emergencies, never before used for tariffs. The Supreme Court heard arguments in November, with justices from across the ideological spectrum expressing skepticism. The court has now deliberated for over 100 days, while the government has collected over $130 billion in tariff revenue that may need to be refunded if the ruling goes against the administration. Here is the crucial point most analysts are missing. The tariff regime and the Iran military buildup are both expressions of the same underlying condition, a United States asserting maximum economic and military authority at the precise moment both are being most aggressively challenged from the outside. The tariffs are an assertion of economic authority. The carrier group deployment is an assertion of military authority. The Supreme Court ruling is a legal challenge to the economic assertion. The Russia-China-Iran trilateral exercises in the Strait of Hormuz are a physical challenge to the military assertion. Gold and silver sit at the precise intersection of both challenges. They are the assets that structurally benefit when institutional authority is questioned, when the ability of any single state to dictate the price of real things through paper instruments begins to erode. And right now, both pillars of that authority are being tested simultaneously, in the same week, in the same news cycle. When a system operates at the edge of its design parameters, small catalysts produce large outcomes. The spring is not wound tight by accident. It is wound tight because we have arrived at the moment when years of accumulated pressure can no longer be absorbed. We must give credit where it is due, because the actions of China and Russia in the waters around the Strait of Hormuz are not reactive posturing. They are not improvised. They are the operational execution of a deliberate, long-range strategy. Understanding this strategy is critical, as it represents the most direct threat to Western pricing authority over silver and gold that exists today. In late January, China dispatched 16 military cargo planes to Iran. Defense analysts report these aircraft likely carried defensive systems and logistical infrastructure, helping Iran rebuild capabilities degraded by previous strikes. China is not a passive observer here. It has signed a trilateral strategic charter with Russia covering joint military exercises and intelligence sharing. It is providing cybersecurity infrastructure to harden Iranian systems, and it is purchasing 90% of Iran's oil exports, ensuring that the maximum pressure campaign does not collapse Iran's economy. Russia has agreed to supply Iran with advanced Su-35 fighter jets. The Russian foreign minister has explicitly warned that any U.S. strike against Iran carries serious consequences. And as of this morning, Russian warships, Chinese naval vessels, Iranian Navy units, and Iranian Revolutionary Guard boats are all operating in formation inside the Strait of Hormuz in a joint exercise. This is the emerging alliance, China, Russia, Iran, operating not as a loose coalition of shared grievances, but as a coordinated strategic bloc with a specific objective: to make the cost of U.S. unilateral action prohibitively high. The Strait of Hormuz deployment is the physical embodiment of that objective. By positioning Russian and Chinese assets inside the exact waterway where any U.S. military operation would need to maneuver, the alliance has executed a move of genuine sophistication. They have not attempted to match U.S. military capability. They have made any U.S. operation more complex, more diplomatically dangerous, and more prone to accidental escalation simply by being physically present. China and Russia are not in the Strait of Hormuz to fight. They are there to raise the price of fighting, and as that price rises, as the uncertainty premium embedded in every barrel of oil flowing through that strait increases, the case for gold and silver as insurance against that uncertainty becomes stronger with every hour those ships remain in formation. The establishment is watching this unfold. They can access the same deployment maps. They can read the comex inventory reports. They can see where the drain rate is headed, and they are not going to allow gold at $5,000 and silver at $80 to climb further without deploying every available instrument to push back. The counterattack is already in motion, And it is not coming from a trading desk. It is coming from the Supreme Court. The tariff regime is structurally inflationary. It raises the cost of imported inputs. It sustains pressure on the dollar. It reinforces the fundamental case for hard assets. If the Supreme Court strikes it down, the immediate market reading is deflationary. The single largest source of administered inflation is removed. The dollar strengthens. In the short term, gold faces selling pressure and silver follows. That is the counterattack. It is the judicial system, operating on a delayed timeline, delivering a ruling that the establishment hopes lands as a cold interruption to the metals rally precisely when the geopolitical premium is at its most elevated, and it may work in the short term. A ruling against the tariffs could push gold back toward $4,500 and silver toward $70. That is the window the counterattack aims to create. But here is the structural flaw in that strategy. A court can strike down a statute. It cannot rebuild a comex vault. It cannot reverse the drain that has already removed over 100 million ounces of registered silver. It cannot put the 16 Chinese military cargo planes back in the air. It cannot cancel the joint naval exercises. And most critically, it cannot undeploy the B-52 bombers sitting on a runway in Qatar or send the USS Gerald R. Ford back to port. The paper mechanism and the judicial mechanism have reach over paper. They have no reach over hardware that is already in motion. As the carriers move and the court deliberates, a third front in this conflict runs quietly in the background, the front of managed perception. Watch how the Iran situation is framed in mainstream financial media this week. The diplomatic track will receive prominent coverage. Envoys met in Geneva. Both sides described some progress. Talks are ongoing. A deal remains possible. This framing is doing significant work. A U.S. official described that same meeting as a nothing burger. The preconditions required, permanent halt of enrichment, limitation of the missile program, are preconditions Iranian officials have categorically rejected on the record. Iran's supreme leader declared that the Islamic Republic will not be toppled. These are not ambiguous statements. They are categorical rejections issued in public by the individuals who hold actual decision-making authority. And yet the frame being constructed is progress was made, a deal is possible. This frame serves one specific purpose. If you believe a deal is possible, you believe the geopolitical premium will evaporate. If you believe a deal is possible, you wait. You do not buy ahead of the weekend. You let the price come to you. That is the function of the diplomatic progress narrative. It manufactures patience in buyers at the exact moment when the operational timeline is shortening. The rule for navigating an information environment like this is consistent across every cycle. Ignore what is being said and observe what is being done. What is being said? Some progress. What is being done? A nuclear detection aircraft has been deployed to the Persian Gulf. B-52 bombers are on a runway in Qatar. 2 carrier strike groups are converging. China is running resupply flights to Iran. Russia is in the Strait of Hormuz with active warships. These are not the actions of parties who believe diplomacy will resolve this in 14 days. These are the actions of parties preparing for an outcome that words will not produce. There exists a category of evidence that is structurally immune to narrative management. It is the evidence of deployed physical hardware. You cannot fabricate an aircraft carrier in the Arabian Sea. You cannot fake a vault inventory report. You cannot invent a nuclear detection aircraft on a flight manifest. When both the military hardware and the physical market data are telling the same story at the same time, the narrative running alongside them becomes irrelevant noise. Let's walk through what the hardware is telling us today. The USS Abraham Lincoln Carrier Strike Group is already in the Arabian Sea. The USS Gerald R. Ford is en route to the Eastern Mediterranean. U.S. officials have stated explicitly that the Ford's arrival is a key factor in the timing of operations, not the timing of negotiations, but the timing of operations. Over 160 cargo flights have run into the region. THAAD and Patriot missile defense batteries are deployed. An Ohio-class submarine, location undisclosed, is carrying Tomahawk cruise missiles within operational range. AWACS aircraft are providing airborne command and control. And at Al Udeid Air Base in Qatar, B-52 Stratofortress bombers have been positioned on an active runway. The WC-135R nuclear detection aircraft is in the region. Its operational purpose is one thing only: detect nuclear material in the atmosphere. When you deploy a nuke sniffer to a region, you are not constructing a bluff. You are preparing to operate in an environment where nuclear material in the atmosphere is a real risk that must be monitored. Now overlay that against the physical silver market. COMEX registered inventory, 88 million ounces. Drain rate, 20 million ounces per month. Timeline to structural delivery crisis at current rates, approximately 4.5 months. In a normal environment, that timeline might hold. But this is not a normal environment. This is an environment where a war premium is about to hit industrial buyers. If you are a procurement manager for a major electronics firm and you watch a news alert that the United States has initiated military operations, you do not call your broker and ask for the paper price. You call the refiner and ask what premium they require for immediate physical allocation. When that call happens simultaneously across every major industrial buyer, the paper price and the real price separate. The paper mechanism cannot process that kind of concentrated physical demand in real time. That is the moment the spread between the screen price and the real market clearing price closes, not by the screen price coming down, but by the clearing price moving violently to where the physical buyers are willing to transact. The hardware in the Gulf and the hardware in the vault are reading from the same script. The script says the gap between the current paper price and the real clearing price is larger than anything the trading screen has yet reflected. Here is a framework for the next 48 to 96 hours. 4 scenarios, 4 sets of implications, 1 consistent directional conclusion. Scenario 1. Military action against Iran. Tariffs upheld by the Supreme Court. This is the most explosive outcome. Safe haven demand ignites. Oil spikes as Hormuz risk becomes real. Inflation from tariffs continues uninterrupted. Supply chain disruption accelerates industrial silver buying. In this scenario, gold does not simply reclaim its all-time high. It exceeds it at a pace the market will not have time to position for. Silver at $80 would represent the entry point that in retrospect was obvious. Scenario 2. Military action against Iran. Tariffs struck down. Complex, but ultimately bullish. Safe haven demand from the military trigger overwhelms the deflationary relief from the trade ruling. War rewrites the oil market overnight. A tariff ruling unfolds over months. In this scenario, gold and silver still move higher, but the path is volatile. Expect sharp sessions in both directions as the market attempts to price 2 large opposing forces simultaneously. Scenario 3. A deal with Iran, tariffs upheld. No war premium, but structural inflation continues. Gold holds, silver holds. The comex vault keeps draining. The long-term structural thesis is completely intact. No major directional move in the short term, but the foundation for the next leg is being laid every single day. Scenario 4. A deal with Iran, tariffs struck down. This is the one scenario that produces a meaningful short-term correction. War fears evaporate. Inflationary pressure temporarily lifts. The dollar strengthens. In this scenario, gold could retrace toward $4,500 and silver toward $70. Hold that scenario honestly, because even if it materializes, it does not change the structural verdict. The comex vault does not magically refill. The miners do not suddenly begin receiving the screen price. The 16 Chinese military cargo planes are not recalled. Iran's rearming through Russian and Chinese support does not reverse. Central bank buying continues. The global silver supply deficit does not disappear because a court ruled on a trade statute. And most critically, a Trump advisor placed the probability of military action at 90%. You do not deploy 2 carrier strike groups, nuclear-capable bombers, and a nuclear detection aircraft as a negotiating prop. You deploy those assets when you intend to use them. Iran's supreme leader has said the republic will not be toppled. Iran's parliament still chants "Death to America" on the floor of the legislature. They are simultaneously running joint military exercises in the Strait of Hormuz with 2 nuclear-armed powers. That is not a country constructing a diplomatic off-ramp. That is a country that has calculated it has backing sufficient to refuse. The net directional conclusion: 3 of the 4 scenarios are bullish for precious metals. 1 is temporarily bearish, and even that scenario cannot address the structural drivers that were in motion before anyone said the word Iran this cycle. Here is the final warning. You can strike down a tariff with a court ruling. You can temporarily push the paper price of silver down with a judicial decision. You can write headlines about diplomatic progress and manage the perception of retail investors. But you cannot undeploy 2 aircraft carrier strike groups that are already in the water. You cannot unposition B-52 bombers from a runway in Qatar where they are sitting right now. You cannot put 88 million ounces of registered silver back into a vault that has already shipped them out. And you cannot negotiate a deal with a supreme leader who has stated publicly that his republic will not yield. The things in motion right now can only resolve in one of 2 ways: a deal that every available signal says Iran will not accept, or an operation that changes the price of oil, the price of silver, and the price of every real asset overnight in a gap open that you will read about on a Monday morning if you were not already positioned on the Friday before. Watch 3 things over the next 48 hours. First, does the Supreme Court issue its tariff ruling today, or do they push to the next available session dates? The longer they wait, the more disruptive any ruling becomes. Second, does the USS Gerald R. Ford arrive in the Eastern Mediterranean? When both carrier groups are in position, the military capability is complete. Third, does any public statement emerge narrowing the operational timeline? Any single one of these developments moves this market. All three in the same window is the kind of event that is not processed gradually by a market. It is processed in a gap. The window you are sitting in right now is the window before the gap. Gold is at 5,170. Silver is at 80.37s. The carriers are moving. The vaults are draining. The court is deliberating. The alliance is in the Strait of Hormuz. Hold the line. If this breakdown helped you understand what is actually in motion right now, not what the headlines are saying, but what the hardware and the vault data are confirming, hit like and subscribe. This analysis is provided every single day, and right now, every single day is a day closer to when none of this can be ignored anymore. This is shadow economics.